Hello, everyone, and welcome to at Barrons. I'm Andy Serwer. Welcome to our guest, John Stankey, CEO of AT&T. John, great to see you.
It's good to be with you, Andy.
So your stock has, and I should say, by the way, Chairman and CEO. Congratulations on that additional role, right?
Yeah, I guess it's time for new business cards, huh?
Yeah, that's it. Your stock has really been on a tear, John, up 60% year to date, or over the past 12 months, I should say. Market capitalization getting close to $200 billion. What's been going on?
I think we hit a 5-year high yesterday or something like that. So,
selling you short.
Yeah, that's right.
So to speak.
Look, I think what's been going on is we set out an objective about 4 years ago where we said we wanted to focus on being the nation's best communications company. And we wanted to line that up with strong investment, getting our folks focused on that objective and become a better company every year. And we've done that. And it's quite a different business today than it probably was 4 years ago. And it's demonstrating that it can execute consistently, driving improvements in cash flow, improvements in margins, improvements in customer satisfaction, improvements in share performance, leading in bringing converged services together, both wireless and fixed. And when you do that consistently, I think the market starts to take notice of the inherent value that's in the business.
Yeah, there's a lot to unpack there. Let's talk about 5G and fiber, those two key elements of the business. Where do you stand on those rollouts?
Well, so on 5G, we're finishing up kind of normalizing our network. We're the first that will move to an entirely open radio access network, which allows us to kind of take advantage of lower cost of equipment, higher performance in the network, and we'll be spending the next 2 years finishing that work. But we're well on that continuum. We've got network scores from our customers that are keeping pace with everybody in the industry, so that's really good. And then on the broadband side, we've been deploying fiber faster than anybody else in the United States, just near 30 million passings right now. And fiber is by far and away the best technology. It's the most durable technology. It's the most capable technology. It's a little bit harder to put in. Takes a little bit longer to get the paybacks on it, but we're at that period now with 30 million passings where we're now starting to see that it's a really strong and durable business. It's growing double digits. Margins are improving as we're getting scale in each metropolitan area where we've been deploying it. Customer satisfaction is off the charts. It surpasses every other fixed broadband provider by oftentimes 10 points in customer satisfaction. That's really good. So we feel pretty pleased about that.
And sticking with broadband a little bit, so what inning are you in there? How much more do you have to go? And then how do you leverage the business to make it even more profitable specifically?
Yeah, I think we're probably in the mid-innings of the game. We have a proven business model, and we've proven that we can go into any metropolitan area in the United States and get to scale. But the reason I say mid-innings is because probably for the last 2 decades, we've been the underperformer on share. Typically, cable is the dominant share provider. I think that game's going to switch now because we have the better technology. We have the better service model. We're leading in converged services of being able to offer a customer both wireless and broadband. And so when you think about the next play here, it's about shifting share. Well, we become a share leader. And when you become a share leader and you get to the density in these markets where you're mostly built out, and we'll achieve that probably around 2029, that's when you get really strong margin performance and you start driving the cash flows in a really differentiated fashion.
Right, and so it's more like a scale play rather than pricing, or help me with that a little bit.
Well, right now we typically, look at price value, we actually price under cable, and yet we're providing a better product. So price value equation is definitely an improvement. And I think that's what's helping us penetrate as rapidly as we are. We're about 40% penetrated right now in our properties that are open at least 3 years. So it takes us about 3 years to get to 40% of the market. That's pretty rapid, from my experience in the industry to move that quickly. That's an indication from the customer that we've got a really solid product. And that next 10 share points, kind of moving over 50%, things are really good. When you get to that point, you start getting in a situation where your profitability is really strong and your returns are really good.
And how do the bundles that are out there affect your business or impact it?
Well, we've been focusing on giving the customer better value for putting two together. Sure, they get a better price than if they were buying the products individually, but we don't lead with discounting. We lead with the fact that the products are better products. I just talked about how broadband is, in fact, a higher superior product. It has symmetrical bandwidth. It doesn't break as often. It performs exceptionally well on latency characteristics and can scale up on bandwidth in all the right ways. But then we have world-class wireless network as well, and starting to do things like add backup into broadband. So if your broadband connection for some unfortunate reason, like the gardener comes in and cuts the line, then we'll back it up to the wireless network until we can get out to replace it. So giving the customer a better product and service and doing it together in a more elegant fashion, that's really what we want to drive toward, not necessarily just playing on price. I think what we see from our competitors who don't own both fixed and mobile networks, that's exactly what they're doing. They're trying to play a price equation. Our goal is to actually give the customer better services that work together effectively.
And by the way, it's better for your bottom line at the same time, right? But you're not shortchanging the customer.
That's correct.
So we've talked over the years, and one thing you talked about doing was investing in the business and paying down debt. And I said, that's a tall order. You seem to have been able to execute that a bit, though.
It was a tall order. It took a lot of work. It was a lot of great work by our employee body. We've managed to keep our cost structure in an improving position year over year while we've been growing revenues. That's business operating leverage is always a good thing when that happens. And because we've been able to drive cash flows up, we've been able to do both. Invest at the top of the industry. Last couple of years, close to $24 billion a year of reinvestment in our business. And at the same time, paying down debt. We're down, probably over $45 billion of debt since I took over in this job. And that was a narrow path to walk, but we're approaching that period middle of this year. We're going to be at 2.5 times adjusted net debt to EBITDA. That's a really comfortable place for a capital-intensive business like ours. That gives us a lot of choice now as to what to do with that cash flow. And we kind of announced over the next 3 years or so, we'll be returning $40 billion to shareholders, combination of about $20 billion of dividends and $20 billion of share buyback instead of working on the balance sheet. So really strong execution on that front. I feel really proud to be at this moment and to be able to lean in, play offense, and use that discretionary cash flow to reward our investors that stayed with us.
Yeah, I saw that $40 billion and the $20 billion for buybacks. First time you've been doing buybacks in a long time, right?
Yeah, I don't remember the last time we did it. It certainly wasn't during my tenure that we did it, but it's probably a solid 8 years, maybe more.
The other thing you did was cut the dividend. People complained, screamed about that, but that seems to have worked out as well, right?
Yeah, the dividend was a hard decision, but, putting it in context, we shed a lot of our business. We sold a media company. We took value of that media company and spun it off to shareholders. We sold some other assets out of the company. When the business gets, over a third smaller, then you kind of have to right-size the dividend to the size of the business. And I think we did that in a proportional fashion, as hard as that decision was. And the whole intent was to rebuild a company that was more durable and could drive those cash flows in the future that were sustainable. And we just talked about how we did that in particular with some of the stepped up investment in fiber that is now driving cash flow back into the company and growing every year, that allows us now to move back into this shareholder return dynamic. So as hard as that decision was, I think it was the right decision long-term for the shareholder, right decision for our employees, that we'll have a sustainable franchise that will be around long after I'm here. And frankly, right for our customers who are getting world-class products and services that are the best out there in the market, that I think will make the U.S. communications infrastructure absolutely the best in the world.
You wrote about something that I noticed, although you quantified it more to a point, which is to say that your dividend yield is down, and you noted that it was below the 10-year for the first time in 2 years. What does that reflect?
I think it's probably below the 10-year for the first time in several decades. I'm trying to go back when.
2 decades, excuse me.
Yeah,
I misread. It was 2 decades.
It's been a very, very long time that we have been below the 10-year Treasury.
Yeah.
And that's I think at one point in time we were butting up against nearly an 8% yield on our dividend, early in my tenure. So it's a great demonstration of investor confidence, I think, in the business and what it's doing, how it's performing, and what we've laid out for the future. And it's just part of that balance sheet restructuring that I feel really proud about.
Revenue growth, John, seems to be dear, though. I mean, you have, $122 billion of revenue this past year, which is more or less the same as what you got in 2023. Are you looking for top-line growth? How are you managing that?
Yeah, I'd like to see more top-line growth. What CEO wouldn't? I'd like to see more profitable top-line growth. I feel really good about what we've been able to do. We've been able to eke out top-line growth that looks close to what's been going on with GDP, at the same time keeping cost structure under wraps and under pressure and working through that. I'd like to see another point of revenue growth come into the business. And the way we have to do that is we've got to start paying attention to how customers need to use our products and services differently, and start to work to add those opportunities on top of what customers buy from us for basic connectivity. Things like customers are concerned about security and privacy. There are things we can do on our network to make their products better for security and privacy that they may be willing to pay us some incremental money on. I think probably if you looked at your home network today, you would say it's far more complex than it was 5 years ago. In some cases, it's starting to get so complex that many people have difficulty managing it. There are probably some things we can do to help customers manage their home networks more effectively that add value and might cause them to be willing to pay us a little bit more for that. If we can drive out another point of growth, that'd be a really good thing for our company. And that's really what we need to focus on over the next 12 to 18 months.
It's interesting you say that, because from a consumer standpoint, it is a complicated proposition. We were talking about family plans, multiple devices, broadband in the home. And if I had one point person or one point of contact at one entity where I could just get things resolved somehow, or the whole process was more simplified, that would be an interesting proposition.
You think about, how critical your Wi-Fi infrastructure is in your home anymore. You can't tolerate, just like you can't tolerate a dead spot on our network, you can't tolerate a dead spot in your home. And we have the ability, by looking at the devices you carry around and evaluating signal strength, what's going on, to be able to engineer your internal network as well. And using tools like AI and the ability to use algorithmic approaches to those things, build that bulletproof network in somebody's home. And I think there are places where we can go to grow this business differently as we move forward.
Maybe this is kind of continuing to harp on that, but you wrote something on an analyst call a while back, or something from an analyst call, where you said, we move away from handsets and routers and cars that are connected to households that are connected. Right. Is that speaking to that a little bit?
Yeah, I think the way I think about it, and I try to use this as a guiding principle as to how we think about operating the business moving forward. Most of our customers, when they wake up in the morning, what's important to them is getting on the internet. They don't necessarily think about, gosh, I relish managing a unique relationship for my broadband in my house, and I want some other relationship when I get on an airplane and travel, or in my car, or on the go. They just want to get on the internet. And really what AT&T should be able to do for a customer is say, establish a relationship with me. I'll just make sure you're on the internet wherever you go. And if we can march toward that North Star, if we can accomplish that, I think we have a place in consumers and businesses' mind moving forward. It's going to require us to stitch together networks other than our own to make that happen. But who's better to do that than us? That's probably not what you want to be doing with your free time when you're at home.
But it's sort of like what happens when you travel abroad, right? If you have a relationship with a U.S. carrier, you just go there and bang, it's supposed to connect to the local partner, right? Which it often does pretty well. So,
and when it doesn't, you're a little annoyed.
No, people just, to your point, people assume this stuff is going to work, and that's on you guys, right?
They should, and that's how it should be.
So I want to shift gears a little bit and ask you about Washington, D.C., of course, always a favorite topic for a CEO. Is anything going on in Washington right now impacting your business? What are you concerned about? Are there regulatory things that you'd like to see resolved or are getting resolved? What's your take, John?
There's a lot going on in Washington
I've noticed
now.
That. Right.
And yes, it does impact our business. Look, I'm pleased with what I see happening right now on spectrum policy. After coming out of 4 years of a previous administration that was contemplating a lot of things, I've already noticed early on in the current administration that they're not contemplating. There's the meetings at the highest levels to make some decisions to what they want to do moving forward. I think this is really important for the United States. We've dropped from being usually number 1, 2, or 3 in spectrum allocated into our wireless networks in developed countries to like number 14. That means our infrastructure isn't as competitive. And more importantly for the consumer, if demand and usage continues to increase every year, and we all are using our phones more, and we're not adding capacity. Spectrum is how you add capacity into a network. Demand goes up, capacity stays the same, pricing tends to go up. And so the way you keep pricing affordable is you add capacity, and spectrum is the best way to do that. So I'm really pleased to see the current administration engaging and making some of the hard decisions that need to be made on the spectrum side. I also think ultimately having less government, a more efficient government with spending under control, is good for the debt markets. It's good to not have the government crowding out private enterprise. And I think if we do that right, that could be really good for economic stimulus in this country. And the direction on tax policy seems to be pro-investment. AT&T invests, as I said, $24 billion-ish a year into our business. When you think about what the pro-tax and pro-investment structure has been on investment tax credits, accelerated depreciation, we're a key beneficiary of that. If I am able to take advantage of that, I can invest more in fiber faster. And we've had to moderate some things as taxes have gone up and those tax incentives have started to age off. Be really excited if that moves. And then, finally, I do watch, and I'm watching what's occurring right now geopolitically. We sell services broadly across the globe. A lot of our customers are customers in Europe, customers in Asia. We're trusted to operate and carry people's data and manage those networks for companies, U.S. companies as well as non-U.S. companies. Our foreign policy and how we're perceived broadly, in particular in Europe, I think is really important to our business and our enterprise dynamic of being a trusted provider. So I'm watching carefully what's going on right now. There's clearly a little bit of jockeying in position as to what our traditional relationships have been and how they should be crafted moving forward. They have to be done in a mindset of, is it driving good economic growth for the United States as well? Tariffs are included in that equation.
Interesting answer. Back to the business a little bit, but the competitive set and the core competitive set, not the cable Comcast guys so much, but T-Mo and Verizon. What do you make of those two guys? I mean, T-Mobile was the rocket ship. Maybe that's kind of topped out. Verizon's had a tougher time. How do you see yourselves compared to those two?
Well, look, they're both very capable competitors. They all occupy different places in the ecosystem of how customers perceive their brands. I don't take them for granted, and I don't think about T-Mo or anybody topping out. I think they're still incredibly aggressive and leaning in every day to try to find new places that they can grow and pick up customers. What I think is different about it is I've made a commitment, we've made it 3 years ago on a bet, that customers are going to do exactly what I said earlier. They're going to want to go to one place to get all their services. They're going to want to have a simple relationship to get on the internet. And they're going to want to do that on world-class scalable infrastructure. So we chose to invest heavily into fiber, and we've chosen to invest in a very capable wireless network. We're leading in that infrastructure of anybody in the industry right now, cable or wireless. And I think over the long haul, that'll put us in a very unique position. So they'll keep doing what they're doing. I'm going to keep doing what I'm doing, which is investing organically in my business, continuing to build out a very, very large and most attractive fiber footprint to pair with my wireless business, build better products, and I think ultimately I prevail in that equation if we do that well.
To your mind, John, can we finally put to rest that marrying telecommunications and media is an optimal business model?
It's at this moment, it's not the right business model. And it's, I think at the time we made the decision to divest our media assets, one of the things I shared was it was real clear that there was a robust investment cycle required to build world-class communications infrastructure, and there was a robust investment cycle required to reposition media for the future. And I didn't know how to stretch our balance sheet to do both. And that's why getting focused back on chasing that robust investment cycle for communications to have some of the best communications products in the market, I felt was the right strategy for AT&T at this juncture. I'm pleased to say it looks like that's panning out over the last couple of years. And clearly, sitting on the sidelines and watching media a little bit as a hobby these days, it's clear that they're having to invest pretty dramatically to reposition their products and services for the next generation as well. And better to have people who are dedicated to doing that full time, not having to worry about splitting their time between both. And I think that's probably been the right thing for our company.
That's a diplomatic answer. And final question.
I'm ever the diplomat.
Ever the diplomat.
I have that reputation.
Yes.
So.
I'll leave it at that. And final question. Another thing that you wrote recently was you said you want to take shareholders on a bit of a ride as part of what your strategy was. It's kind of an afterthought, but it's an important thought. And I'm wondering for people out there who've seen the 60% rise over the past 12 months and think, dang, maybe I missed this stock. Why should investors hang on to the stock now or new investors buy it?
Yeah, there's cycles that go in markets and sometimes industries fall out of favor. There's an economic cycle and interest rates move and you're an interest rates sensitive stock. But I think what investors should look at, what's the inherent value of the business over the long haul. And there's no question, we made some decisions a couple of years ago, as I indicated, to invest for a longer haul set of objectives for this business. And it doesn't surprise me given how liquid markets are right now that people said, well, maybe I'm not in for the front end of that. Maybe I'll go someplace else. And if it starts to work, I'll come back in. We're possibly at that moment right now where you see, as you indicated, and you see the appreciation of the stock that's gone on. That doesn't mean that should be the end of it by any stretch. One, we'll be buying back shares. We're going to pull back in some of the shares that were issued for previous M&A and resize that to the current size of the business. I think that will be good, but we're not near the top of our game. We still have more fiber footprint to build. We still have more converged customers to bring on. We can still do better in small and medium business than what we're doing today. That's going to drive incremental cash flow growth as we've shared over the next 3 years. So there is more value to be driven out of this company and operating it more effectively. And I, welcome anybody to come in at any time. You ought to come in. The water's pretty good right now.
All right, John Stankey, CEO of AT&T. Thank you so much for joining us.
It's good to be with you, Andy. Thank you.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.